What's up guys, hope you are doing great. I'm a big believer that you should understand the product or the service that you invest in. Most of you guys know Pick n Pay, you use its products and you experience the service that they deliver. In this video, I'm going to analyze the company and share whether it's a good opportunity to invest in Pick n Pay right now. With that said, I've received a lot of requests from you guys to analyze the company. Year to date, the company is down around 55%, and a lot of people see this as an opportunity to invest in Pick n Pay. Stay until the end of the video to see whether it's actually a good investment or not, and hopefully you can learn a thing or two. If you haven't seen my previous video, I started using a platform called Brokestock where I created a portfolio from scratch and I invested around 2,800 Rand in MTN. So if you haven't checked that video out yet, make sure you go and have a look. And if you want to start investing, consider downloading Brokestock using my link down in the description. I get a small incentive when you sign up and it really supports the channel. And again, it's a really cool platform to use. And my goal for this year would be to grow my portfolio as large as I physically can and keep you guys updated with what I buy. Give me a thumbs up in the comments if this is something that you would like to see, and I'll share all of the companies that I'm analyzing as well as the ones that I end up buying. So when I open Brokestock, here we can see my current balance on my portfolio. One thing that I always like to do, and I shared it in a previous video, is to click on the indicators tab and scroll down and figure out the PEG ratio of the company. A PEG ratio is simply your PE ratio divided by the earnings per share growth rate, which gives you an amount above or below 1. So we can see that Pick n Pay has a forward PE ratio of 7 and an EPS growth rate which is negative. This automatically means that the company is overvalued because it's actually losing money and not generating money. So this metric that I normally use won't be helpful in any way, so we'll have to do some extra research. One of the main things that I like to do is to physically download the annual financial statements of the company. Here we can see some key metrics showing that the turnover is up with 5.4% and the gross profit margin is 18.5%. The trading profit was only 31.8 million Rand and it took a loss of 837 million Rand. And like we can see, the turnover was around 54 billion Rand, which is a 5.4% increase, but the gross margin decreased to 18.5% from the previous year. It was 19.4%. And the trading profit for the year was only 31.8 million Rand. It's a 97% decrease from the previous year. This also meant that the company will not be paying any dividends during that period, compared to the previous year where they paid 44.85 cents per share. And some of the results summaries that the company shared is that the group delivered a disappointing result in a period heavily impacted by load shedding and increased competitive intensity. The 396 million Rand spent on diesel to run generators and keep stores open not only impacted expenses growth but also constrained Pick n Pay's ability to respond to increased promotional activity in the market. And I personally think that Pick n Pay has been struggling to keep up with the increased competition as well as the issues that we face in South Africa. Although it's not all bad news, there is some aspects of the company that is showing some growth, like Boxer, as well as Pick n Pay clothing, as well as its online sales that grew around 76% due to Pick n Pay's ASAP. But that alone doesn't make it a good investment. So what we'll do is we'll scroll down and we'll look at the important stuff before we make a decision. So we'll scroll to the income statement, and this is where we can see that the loss for the company was around 880 million Rand, which is a lot of money, especially compared to the previous year. When we scroll down and we look at the financial position or the balance sheet of the company, there's one thing that I like to point out, and that is that the retained earnings of the company is steadily decreasing. So this is not a good sign, because retained earnings is the amount of money the company can put away after all of its responsibilities is paid for. Look at it as a type of savings that the company has. Another really bad thing, and I think this is something that spooked a lot of investors that actually owned Pick n Pay shares, is the long-term borrowings. So that's around 4.5 billion rand of borrowings that the company basically had to raise so that they can keep the company running and potentially increase its growth overall. It's important to understand that a company that has a lot of debt is a risky company to invest in, especially if they cannot generate enough cash flow. At the end of the day, like you guys might know, I prefer investing in a company that can generate cash flow, and although net income is a good way to analyze a company, free cash flow at the end of the day is more important, because you remove all the fancy accounting metrics that companies use to reduce their overall tax rates. Net income, for example, takes into account non-cash expenses like depreciation and amortization, where free cash flow simply represents the amount of cash a company has available after accounting for its operating expenses as well as any capital expenditures. So at the end of the day, free cash flow is what really matters, because that's the amount of money that's left with the company, or the money that they generate from their core operations. If we scroll down and we look for free cash flow, we simply calculate free cash flow by simply taking cash generated from its operating activities, which was around 2.3 billion rand, and then we just deduct all of its investment in property, plant and equipment. So that is known as PPE, or capital expenditures. So we'll take the 2.332 billion rand and we deduct 1.782 billion rand, which gave them a 550 million rand free cash flow position. Although that is not a lot, let's quickly compare it to the previous year. It had cash flow of 1.468 billion rand, and we'll deduct the 1.242 billion rand of capital expenditures, and they only had 226 million rand of free cash flow. So they ultimately doubled their free cash flow position, although they made a loss on its income statement. So it's really important to consider stuff like that. And at the end of the day, if we look at Pick n Pay's shares, we can see that it has a current PE ratio of 64.45, which in my opinion is really expensive. If we click on the 5-year chart on Pick n Pay, we can see that the company's shares has been decreasing steadily over the last year, basically starting around the 1st of January in 2023. So the big question is Pick n Pay a good investment or not? Is it a company that you should consider investing in to grow your portfolio or not? In my opinion, when I look at Pick n Pay, I only see uphill battles, and they have a lot of headwinds that is coming their way. If I think of walking into Pick n Pay and buying products from Pick n Pay, the experience that I have when purchasing items from Pick n Pay isn't necessarily a good experience. I'm not sure if I'm the only one, but that's like the emotional or the psychological part of investing, and experience the product or the service that the company offers. When I go to Pick n Pay, normally I walk out there very disappointed or irritated because they never have the stuff that I need, or the quality of their food isn't really good. So I will much rather consider going to Checkers or Woolworths. Let me know if you want me to analyze Shoprite or Checkers or even Woolworths in a coming video. And hopefully you guys learned a thing or two with this video. With that said, let me know if you want to follow the journey where I grow my portfolio on Brokestock. Again, if you haven't already, make sure that you download the app using the link in the description, and enjoy the process.